It's time for the Your Personal Bank Show with Ferenc Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank in Formation. Take charge of your financial future with your personal bank. Now here's Ferenc Toth.
Welcome to Your Personal Bank Show. We're going to talk about something today that very rarely do I ever hear anybody discuss. And I think we're going to talk about negative interest rates, okay? Negative interest rate bonds and things like that. And the reason I think it's not discussed widely is, it's a relatively new phenomenon. And I do believe it's something that's very, very little understood. And it's little understood, I think, in big part because it's generally speaking, it's not a topic that the average individual investor deals with. It's more of an institutional investor type of thing. And it gets into the central bank kind of thing, and it can get kind of convoluted and complicated. There's no argument here, but I just want to touch on it a little bit because I think there's some things that, although you and I will probably individually never be purchasing. I'm hopeful we'll never be purchasing a negative interest rate bond. But it's I think it's helpful and important to at least have a little bit of an understanding about it and why it even exists. What is it? What is the purpose for it? You know what I'm saying? Why do large institutional investors and things like that? Why do they purchase these things? Okay, first thing before we get into it, I guess I should point out, and like I said, I'm putting a little bit of my banker's hat on right now, okay, because it does kind of really fall heavily into the banking world, if you know what I'm trying to say. But why would somebody purchase? First of all, let's touch on what it is, and then we'll touch about more on why would somebody purchase this, okay, and what a negative interest rate bond is. Simply put, is you're purchasing it for a higher amount than what you're going to receive. So, for example, if you bought a 10-year bond, okay, how bonds normally work, I guess I should back up a little bit. Let's say you got a 5% return bond. If you purchased it for 100 and you sold it for 10, you would ultimately kept it to maturity. You would get the 5%. You get paid when it matured for the 5% more, or whatever it was set for. In other words, you get a return, okay, a positive return. You purchase it for this amount, you're going to be able to, at maturity, sell it for that amount. And generally, that's a positive number. And that's how you can calculate your returns. Some pay interest, some don't, okay, that kind of thing. So keep it simple. One that didn't pay interest, say at a 5% no interest bond, just to keep matters simple. Most do pay interest, but you know what I'm trying to say. If you purchase it for $100, you'd sell it for $105, you get a 5% return, right? Well, negative interest rate bonds work the opposite. You actually pay more for it than you're going to receive down the road. Okay? Well, that just sounds right off the top counterintuitive and counterproductive. And there is a lot of resistance to it. There's a lot of debate, a lot of argument about, is it something that's of value and should it even be used? Of course, it's been in place now in Europe now for quite a few years. They've been dealing with these kinds of things for a while. And again, there's a lot of folks that think they're really bad, and there's some that think they're positive. Okay, and why would somebody even bother to purchase one of these things? Okay, one of the reasons, pretty much, and it comes down to it, and I think it's kind of a sad reason, but it's a safety thing. In other words, if a investor, and like I said, typically we're talking about institutional type investors, pension funds and commercial banks and central banks and things like that we're talking about. They feel like that there's going to be a loss that's going to be greater, a market loss or whatever, that's going to be greater than the loss that they're going to basically lock in by purchasing this bond. So it's a pessimistic view. Let's face it. It's a negative view on what the future economy and growth and investment opportunities are going to be. Okay, so it's in essence it's a safety hedge. They're limiting the downside, if you see what I'm trying to say. So if it's a negative 1% bond, then their downside negative is limited to just the 1%. Okay, so if you felt that the future returns were going to be worse than that, then that's where that's where somebody might consider a negative interest rate bond. Okay. Another purpose of it I guess that's pretty much the simplest one. Like I said, I'm trying to take something that's not overly commonly understood and can, again, be very complicated. I'm trying to simplify it to, make it so it's fairly well understood. You know what I'm saying? So I'm trying to take a difficult concept and narrow it down. So it's, by all means, please, if somebody's come back, you didn't cover this point, you didn't cover that. That's not my goal here. I'm not trying to cover, be a comprehensive education on negative interest rates bonds here. I'm just trying to get a simple, quick overview. So we're not going to cover all the details by any means. And I'm going to share with you in a few minutes, why I think it's important to understand and know. I guess the reason I brought it up, I'll put this up and then we'll go into some of the other reasons perhaps, is China. And this is actually another one of the reasons why people purchase it. But China just, for the first time ever, just issued this past week negative interest rate bond offering. And actually it had a record. Lots of people bought into it. Majority of the investors were from Europe. And in general, the reason was, well, a lot of them that were invested in the European bonds, there's a lot of German bonds right now that are considered a safe haven, as I stated before. If you think the outlook going forward is negative, you can limit your downside. And like at this point, roughly, the negative interest rate bonds through Germany are about 0.75 to the negative, right? They moved out of those and purchased the Chinese ones because they believe, here's where you can actually make money on a negative interest rate bond. Again, it's counterintuitive. But you can make money on it through currency differences. So in other words, if you bought a Chinese one, so you have exposure now to the China market more versus Europe, which is a lot of the thinking of these buyers, even though the return is a negative on the bond, the difference in the valuations of currency, China versus Europe or the U.S. or whatever, you can benefit from those differences. And if you think the economy is going to recover in China over time and their currency gets stronger, they can make a positive return on the currency differences. You see what I'm trying to say? It can be a very complicated process, okay? There's a couple other reasons that folks can purchase these. I don't want to get into all that because, again, it gets into a liquidity situation where it's the efforts by the central banks. That's the maybe the third major reason. Then we'll move on, is by, in essence, forcing banks and such, if they keep cash or businesses or whatever keep cash, and by this is forced, if they keep it, they're going to lose money, right, with these bonds. So it forces them to allocate those dollars, so to put it into the economy and get things going. So it's an effort by central banks and such to try to get a sluggish economy going. Now, that's where a lot of the argument is, does it work or not? We have some results for a number of years now from Europe that kind of shows that so far, at least, it just hasn't had much results. It's been pretty tepid at best. And secondly, the other problem it does is by forcing really extremely low interest rates, which is what we're dealing with right now. And that's why I brought it up, because I'm going to tie in why this is important to understand. And I guess I'm going to have to do that in the next segment because I just got the 1 minute mark. But one of the things it does is the cost of borrowing, of course, goes down, right? Interest rates go way down. It gets cheaper to purchase things. That does tend to make the price of things go up, though, because if you take a house, okay, you purchase a home. If it's cheaper to borrow to purchase the home, typically the price of the home goes up. We're going to touch on this a little bit more and why this is important to understand, thinking forward about your money, your retirement, how this is going to impact your income, all those good things. So stay tuned. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back. We're talking about a subject that's frankly little understood, and that's called negative interest rate bonds. Very little talked about. Again, the average individual investor probably will never deal with this, hopefully. But it is something more on the institutional investor side, okay? And I deal with, I've been dealing with some of this kind of stuff in terms of dealing with the bank kind of stuff and looking at it. Here's the thing, as we shared, and you're hearing a little bit of hesitation in my voice because I'm trying to take a concept that's little understood, can be very complicated, frankly, and just trying to boil it down to more simple, understood, the basics, okay? And again, we shared in the first segment, a negative interest rate bond, negative yield bond is literally where someone basically pays more for the bond than they're going to receive ultimately. And why would somebody do that? Because it just seems, gosh, you're investing your money. Why would you do that? Why wouldn't you just throw it in the mattress? You know what I'm saying? You'd be better off because, there's some reasons. Some investors, institutional types, they're looking at it as, well, they have certain asset allocations. They have to have a certain amount in bonds, for example, things like that. And they have a pessimistic view of the future of the economy and returns. So if they take a negative interest rate bond, say it's going to lose 0.5%, so it costs them 0.5% in losses overall, they feel like the negative downturn is going to be more than that. And so it's a hedge to protect limits their downside. You see what I'm saying? So if they have that asset allocation, they understand they're going to take a loss, but they're putting a floor on the loss. In essence, they're only going to get a negative 0.5%, and that's the worst case scenario on those dollars. You see what I'm saying? So that's one reason why you see it. The other one, like the reason I'm bringing this up is China, for the first time ever recently, just issued a negative interest rate bond. Now, for China, it was great because it brought in a bunch of cash, right? So they can reallocate those dollars, put them to work, and grow their economy, which is another reason why some people invest in that, because they feel like that China has more upside potential growth with their economy, which I think most people would agree right now, post-COVID. And so they literally they're looking at the currency differences, so they can make their money on the currency differences, right? So that's where they can make some money. And then the third one, it has to do with basically liquidity, central banks, and those kinds of things, getting them to put their money in businesses, to put their money to work rather than hoarding cash. Getting banks to loan money and get the economy going again. And it's a tool that's being used. It has been used in Europe for a number of years now as a way to try to get a sluggish economy moving. Now, that's where a lot of the disagreements occur in terms of, is it a good policy, financial policy or not? Does it work? Doesn't? Looking at Europe, who's been using it the longest, I'd say, to be fair and honest, the results have been tepid at best. Generally speaking, in fact, a lot of the large, big dollar investors in Europe, where they have some money in the bank, a significant chunk of money in the bank, insist the bank keep their cash deposits in cash in the safe in the bank, so that they're not subject to the negative interest rate stuff. So in other words, the general public has not really accepted it as a good tool. Now, the only other thing it has done is, by keeping interest rates extremely low, which we're dealing with right now as we speak and have been for a while, this ultra low interest rate environment, the price of things, the cost of things tend to go up that you would borrow money for, because the cost of borrowing. So things like houses is a perfect example. If you're going to purchase a house and you're going to get a mortgage to purchase the house, which most people do, if the cost of borrowing is cheaper because the interest rate is lower, well, the prices of the homes tend to go up. And that's a big part of why there's been a shortage of homes, and there's been that too. But that's also another big reason why real estate prices have held strong and continue to go up, because, the cost of borrowing is so cheap. So is that people are purchasing homes. Okay, that's good, but that helps the economy. But the overall pricing prices a lot of people out then. So the home ownership, like percentages of people who own homes, is at a low point because of that. So you see there's trade-offs, right? And so it causes a lot of challenges in terms of what to do and understanding this and how it impacts the economy and your money going forward, because one of the things it does do is it just devastates folks who, we're taught to work hard, save, pay off our debts, retire, right? The problem is if you become a saver and you put not an investor, but a saver, you've put money away. When you have this low interest rate environment, it really kills you. Even if you're an investor and then later you move into distribution, you go into retirement and you're going to the distribution phase, and now you're trying to take an income off of some fixed income, fixed assets, things like that, low interest rate environment kills you, because with a lower interest rate, of course, you get less income. You need more dollars to create the same income. So that's a struggle. And when you have an extremely low interest rate environment, like we're dealing with right now, and looks like the foreseeable future, according to the Fed, it really causes folks who are trying to live off of income, trying to supplement retirement, it causes a real challenge because the returns are so low. That's one of the reasons why, I've shared this previous shows. If you've listened, I'm not saying this to brag. I was one of the top 10 annuity producers in the country. We're talking about late 90s, early 2000s. By some of the top annuity companies in the country. Okay, annuities were paying good rates of return at the time. There was guarantees, could get guarantee income, consistency. I mean, all those kind of things appealed. Irregardless of what you hear out there about, some people say annuities are bad or whatever. Here's the thing, and I've said this over and over again. It's a pet peeve of mine. There's no such thing as a bad financial tool. They're all designed for different purposes. There's bad fits. I see that all the time where somebody's goal is one thing and they have an investment that is good at doing something else. That's a bad fit. Annuities are designed for the guaranteed income, supplement retirement, not outlive your money. Those are all good things. Okay, so I'm dealing with a clientele that was of concern. The problem is, then the low interest rate environment came along. Of course, those guaranteed incomes all started going down. And that's why I started looking at the personal bank. Hey, you got companies today still paid 6%, have for the last 25 years plus, never missed a dividend since before the Civil War. Well, particularly in today's interest rate environment, that's really strong. And why are they able to pay a higher dividend than, say, a typical annuity is really quite simple. I get this question all the time. How does this extremely low interest rate environment impact the dividend rates that we're seeing, okay, with the personal bank tools? Well, I'm going to have to touch on that more in the next segment because I don't have time to before the next commercial break to cover it. But what I want you to understand is the dividends that are paid on the personal bank is, well, there's a different calculation. Maybe that's the best way I can explain it. In the next segment, I'm going to encourage you to stay tuned because most investments we're all familiar with typically look at quarterly returns, okay? They're looking at the results, stocks and things like that, of course, do that. Annuities can look at a little bit longer time frame, particularly talking about guaranteed lifetime income, so you can get some better returns on those, by the way, than you can on a typical bond, for example, especially today, because there's some longevity involved in there. So in other words, if you set up an annuity and your purpose is to supplement retirement, okay, and you set up a guaranteed lifetime income option, which is very popular, they're going to base that on your actuarial average life expectancy. So if they're looking at you're going to live 10 or 20 or 30 years, let's say, the company knows they have X amount of dollars they're going to be able to use to reinvest and make more for the next 10, 20, 30 years, right? So that allows them to give you a better return or a higher return than just like a straight bond or things that are affected more directly by an interest rate environment. So that's why annuities have become so popular tool to supplement retirement. Your personal bank has some of those same benefits we're going to talk about in the next segment, but additional like tax benefits on top of it. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show, and we've been talking about kind of a difficult subject, a little known. It's called negative interest rates, negative interest rate bonds, things like that. And I just want to say, I don't want to go into a lot of detail about it again. I really touched on it much stronger in the first couple segments here. If I'm going to encourage you to go back to the yourpersonalbank.com, listen to the previous shows if you missed it. You can listen to any of the previous shows, by the way. But yeah, I'm trying to take somewhat of a difficult, little-known concept and boil it down to simple, understood terms. Negative interest rate bond is basically where somebody purchases it. When they purchase it, they pay more than they're going to receive at the end. Again, most people they look at you funny when you when that comes up. Why would you invest money to lose money? Well, again, it can be if you're an institutional investor, you got an asset allocation, you have to have a certain amount of bonds, and you're pessimistic about the future returns of bonds. This can guarantee that, future economic situation in general, I should say, you can guarantee or limit your downside that way. That's one thing, sort of a safe haven kind of thing. What I would say to an individual would be more like, hey, if you're pessimistic about the economic future, why lock in a loss? Might as well get into something that has some guarantees, safety, consistency, like your personal bank or an annuity maybe. At least you get a positive return, right, with some guarantees. But anyway, and then there's reasons in the banking industry, liquidity, push the get the economy, get loans going, things like that. There's reasons behind that. Like I said, go to the previous segments for more information, or contact me at yourpersonalbank.com. Be happy to discuss it with you if you have any questions. But how does it affect us and our money and as individual investors for the most part, and we're just trying to supplement retirement and those kinds of fun things? Well, I mean, it pushes interest rates down generally. In general, that's the part of the purpose. And with a low interest rate environment, as we've been seeing particularly recently, we've seen a low interest rate environment since 08, 09, frankly, for the most part. And things were starting to inch up. My opinion, I think that the Federal Reserve, I think a lot of people agree with this, was far too tepid in bringing interest rates back up to normal levels after 08, 09. I think they got shell-shocked. The financial crisis, what became known as the Great Recession, all those things from 08, 09, had a lasting impact on people, particularly in the money industry, because the financial industry got hammered. And real estate, in many parts of the country, flat out just got hammered. And when you get hammered like that, it causes some PTSD. You're shell-shocked a bit, and so it makes an impact on people and how they think about money and their emotions and how they feel all the way up. I mean, the federal board members are human beings themselves too, okay? So I think there was a resistance to get back to normal because of that. Really, what we thought up until this year, 2020, was a once-in-a-lifetime experience. I mean, there's stories about the same kind of thing from the Great Depression, okay? It impacted how people thought about money and felt about money for the rest of their lives in many cases. There's definitely an emotional impact that's significant when something like that happens. Well, 2020 and COVID and the shutdowns and all that have created a whole new set of unexpected, dramatic returns or situations. And, there's going to be some emotional impact from this too, to be frank with you. It's going to be flat out, it's going to impact some people for the rest of their lives. But beyond that, the low interest rate environment, a lot of people are concerned about, because if you're trying to live off of some of your investments or savings or fixed income or things like that, that's where it really hurts people, because you have to have so much more money. Say, if you want to supplement your income a certain amount, you have to have so much more to create that same income because of the low interest that's being generated. And so, like I was saying in the previous segment, late 90s, early 2000s, I was one of the top annuity producers in the country. Some of the top annuity companies in the country. And this is what I did personally, because there was good returns, there was guarantees, there was safety. We could create a guaranteed lifetime income for folks. There was over and above what typical bonds and things like that were paying without the risk. Again, whether you like annuities or not, positive, negative, they have a place. They have a purpose, like any financial tool. Again, if somebody says this is bad, gives you general statements that this is bad or that is bad, I don't care who they are. They're just sharing with you their personal bias. It's not advice. And in many cases, it doesn't apply to you. So I encourage folks, when you hear these general blanket statements, to ignore that In fact, my recommendation typically is if there's any good very few people that share all bad information. Take the good out of it and move on, because that person's not giving you advice or just sharing with you personal bias, okay? Well, my point is, for a tool to supplement income, particularly retirement income, create a guaranteed lifetime income, a quote-unquote pension type check, if you will, okay? In other words, it's like sometimes I would say to people, you want another check that comes in every month, guaranteed, certain amount, like Social Security or like your pension. You can create that. You can create that type of a situation. And the interest rates were solid and good, and we could lock in some nice rates and guaranteed for folks. And it's, frankly, it's worked out for decades for some of my clients. It worked out great. The problem is, after 08-09, the interest rate environment has changed dramatically. To get those kinds of returns has gotten more difficult. Now, with those types of tools, you can still get much higher returns, guaranteed, supplemental retirement and such, higher than what typical bonds or anything like that these days are paying by far. And we still deal with some of those. If you want more information on that, contact us at yourpersonalbank.com. I'll show you what some of the best returns are, best rates, all that good stuff. But what the personal bank does, and the annuity too, by the way, when it does that, why can it pay a higher rate? A lot of people say, why can you get 6 or 7% or whatever in a guaranteed lifetime income still today? Well, it's a combination of the returns the company can make and then pay back to you and still make a profit, but also has to do with longevity or actuarial numbers. In other words, if they're going to pay you out for the next 20 years, they know they're going to have most of the money, or they're going to have a certain amount of the money they can use to invest over the next 20 years. The first of the 20 years, they'd have most of it, right? And a declining amount available to invest over time, right? So they can enhance the returns. They can, more than just looking at what the current interest rates are, like what a bond would do or other things like that, right? A fixed income type of account. That's why it works and will continue to work. Now, the advantage the personal bank has on top of that, this is why I'm have become such a proponent of that and what the show is all about, is you have the same actuarial benefits, so that's why the dividends are still currently 6%, okay? It's based on profits of the company and things like that. These two companies have huge amounts of cash reserves. I get a lot of these questions. What about, how does that affect the dividends with this low interest rate environment? They have huge cash reserves to survive decades of this kind of stuff and keep the dividends at a strong rate. Like I said, currently 6% still. But it's also based on the actuarial numbers and things like that. But here's the last part of it. By bringing in the bank line of credit, remember, we're putting all the money in the policy to earn right now 6% dividends if you're choosing the fixed steady Eddie option. We can do the index option. That's another whole thing. But my point is, when you leave it there, obviously you get the 6% dividend, right? But when you access the funds, and folks, let's be real, you're investing money for at some point to be able to use those dollars. Am I correct? Now, whatever you're investing it for, it doesn't really matter. You either want to invest that money so you can enhance opportunities in the future, supplement retirement, pay for college, whatever, college education funding, purchase items, whatever it may be. We're going to spend some, if not all of that money at some point in the future, right? Well, here's where the personal bank separates itself. This is the game changer. You can access the funds and pick up positive arbitrage. In other words, still earn interest on money you spent. This is huge, absolutely huge. And why can you do that? If you're getting a 6% dividend and you access the funds from the bank line of credit, where are the funds coming from? You taking them from the insurance company or from the bank? Obviously, you're taking them from the bank. What's the bank charging you? In the 3s. If you're getting credit at 6 and you're getting charged somewhere in the 3s, what's happening? You're keeping the difference. You're keeping 2-3% positive arbitrage. Don't miss this. Stay tuned. Next segment, I'm going to go into this further.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, we're rounding third. Here we go. We talked about, at the beginning, the first couple segments, about negative interest rate bonds, these kind of things, how they impact our economy, investments or retirement, interest rates, all that kind of stuff. If you missed it, go to yourpersonalbank.com. Listen to the first part of the show. By the way, you can listen to any of the previously recorded shows anytime you want. Obviously, you can contact me at yourpersonalbank.com for additional information. Be happy to talk to you about this, how this can impact your financial future, get you, enhance your returns, reduce taxes, increase your income, okay, to supplement retirement or any other purpose for that matter. And again, why does it work? I was sharing with the interest rate, the negative interest rate bonds help create and produce these low interest rate environments, right? And the central bank and Federal Reserve and those kinds of things, their policies around the world, actually, central banks. The problem is with all that, and a lot of that is done, of course, to try to stimulate economy when they think the economy is tepid, with shutdowns, with COVID and things like that, at least part of the economy being shut down, part of the states, it does have a negative impact on the economy, no question. High unemployment, all those things do. And so the reality is the problem that causes folks, though, is those that were savers, those who invested money, who've done things right. I like to say you put money away, save for the future. You paid your bills, you're trying to retire, you're trying to live off of this stuff. And now the interest rates are much lower than they were, say, when you were planning for this, which means you either take less income or you have to have so much more money to create the similar income because the interest rate's so low. And that's the problem I run into on a regular basis with clients who are nearing or are retired, okay? And it makes it tough. And that's why, like I said, years ago, I used to use annuities extensively to help offset that, because you could get, with a guaranteed lifetime income, you could lock in 7% rates, even 8% rates of return on guaranteed income lifetime. Those things are hard to find. You can still get good ones, better than bonds, but it's because of the longevity risk with those. Now, instead of looking at just the current interest rate environment, the company was looking at, well, how much can they make on the money over the next 20 or 30 years or however long it was they thought you were going to live, right? And that's why they can enhance or guarantee a higher rate. Your personal bank works kind of similar situation. You got that longevity, you got the actuarial benefit there. That's why they're able to pay the 6% dividends even today, half of the last 25 years plus, okay? And there's some profitability. So the additional advantage is part of its profitability of the company. The more profitable the company is, they can also keep those dividends strong. And cash reserves. There are companies that have literally billions of, we're talking decades of cash reserves to weather the storm of a low interest rate environment. I've been asked this question a lot this year, particularly. What do you see going forward, the interest rate environment? I know it's been paying 6% plus the last 25 years plus. Could that change? Yes, the answer is it could. But they also tend to move incrementally. We're talking 1/10 of a point or two, typically. So very small incremental changes that will occur. And again, it's because of the long-term longevity. It's the consistency of the companies, the profits of the companies, the cash reserves that they have in place to be able to weather a multi-decade low interest rate environment situation. They've done it before because, again, pretty much the companies we work with, for the most part, have been around since before the Civil War. So we're talking 150-year plus history. That's strong, okay? Really strong. That's what we tend to deal with, okay? So we're looking at solid, strong dividends, particularly when you compare it to the market, for the first, long-term future, all right? And then when you add on top of that, remember, we're putting the money into the personal bank to grow cash, the policy to grow cash, maximize cash growth. That's the other question I get, what's the cost of insurance and things like that? Well, first of all, we're structuring to maximize cash and minimize death benefit. So if we cut the death benefit in half, for example, and we usually do much more than that, but if you cut it in half even, you just cut the cost of insurance in half, didn't you? The fees, the cost, whatever's involved. And oftentimes we're cutting it far more than that. So frankly, the costs and the fees get to be very, very competitive to what most people are familiar with mutual funds and various other investments like that. it's shock. They're surprised, pleasantly surprised. So that's one of the most common comments from advisors in particular. There's this misconception out there that there's a high cost of insurance. Well, if you're purchasing strictly for insurance purposes and you're maximizing death benefit, that can be the case, absolutely. But we're not doing that. We're doing the opposite. We're minimizing death benefit. And by doing that immediately, we're minimizing cost of insurance, minimizing the fees, okay? And the other common misconception is, well, my age and stuff like that, health-wise. I've had folks qualify for this successfully, and the numbers worked out great up to age 79. I have clients up, average health. You don't have to be tremendous health. If you got major health issues, yes, there could be some challenges there. But what do? We look at insuring a partner or a family member or business associate, something like that. You own it. You get the benefits of the tax growth, tax-free, all that good stuff. Okay, the guarantees, all of it. So don't let age or health or those kinds of things or fees cause you to not even consider this, because I think you're going to be very, very pleasantly surprised. Most people are. But don't forget what the real game changer is. This is where it separates itself from any other investment or financial tool out there that I'm aware of, that I've ever seen. And I've been doing this for 20 plus years. I've been speaking around the country. I've been on the radio now for over a year. I still haven't seen anything else in comparison to it, and nobody's brought it to my attention. I'm dealing with starting a bank, you name it. In fact, when I share this concept with money people, whether it's the banking industry or any other area, they're usually, the response is overwhelmingly positive. They're like, wow, that makes sense. I need to look into this myself, and many do. When you add the bank line of credit to the piece, you're getting 6%. You put the money in a policy, you're getting 6% dividend. We're maximizing cash. We're looking at 50 to 85% cash liquid day one, just so you know. Then we bring in a bank line of credit using the cash in the policy as collateral for the loan. Okay, so it's a simple, easy to qualify for a loan. Literally, the application's like one page, literally. And unless you have a judgment or lien, you're going to qualify, basically. Okay? It's that simple. Doesn't affect by the way, it doesn't even affect your loan to income ratio, things like that. I have a lot of real estate investors who are very concerned about that. Doesn't affect their business for those kinds of purposes, for borrowing purposes. In fact, it's not even reported because it's a collateralized loan. It's not reported as a debt. It's a collateralized loan. Okay? So that's why it doesn't affect your debt to income ratio. Here's the thing. When you access the funds, remember, all of us are going to use money. We're going to use some of our money we invest, whether it's today or tomorrow. At some point, we're going to, aren't we? Unless we kick the bucket and go, then our heirs will. But the bottom line is some of the money is going to get spent. And that's part of the purpose, right? Well, here, when you access the money, are you taking it from the policy or are you taking it from the bank? And obviously the answer is from the bank. The bank it's a bank line of credit. They're sending you the funds. Therefore, the cash in the policy is still there, still earning its 6% dividend today. Okay? What's the bank charging you for doing that? 3 to 3.95, depending on how much money we're talking about and how long you've had the account. So here's the thing. If your money is growing, getting credited 6, and you're getting charged in the 3s, when you spend it, remember, this is only when you spend it, what's happening on the spent dollars? You're picking up 2 or 3% positive arbitrage. You're keeping the difference, right? Where else can you earn interest on money you spent or allocated elsewhere? How about earning interest on money on every dollar you ever spend? You ever think about that? How about enhancing your rate of return by 2 or 3%? What would that do to your overall investment portfolio? If you get a 10% return, that'd be a pretty strong return. Most people agree, especially today. You want to make 12 or 13? Do you think that would make a difference? Especially if you added that up over a number of years? Are you kidding me? This is why I love working with people over a number of years, because their financial situation dramatically changes. It improves. It enhances their financial situation, both personally, their family, and their business. It's fun working with people over time. Just keeps getting better. So like I said, as always, stay tuned to the Your Personal Bank Show. We're on every Tuesday at noon and Thursday at 1 on Money Radio. And as always, contact me at yourpersonalbank.com for more information. I'd love to talk to you about how this can enhance your financial future.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.